Thank you very much for attending another session of RM Smart Investing. It's so wonderful to be with you. Today, we're going to talk about something, in my opinion, is pretty exciting. And I believe it's going to be even more exciting in the coming weeks and months, based on what I've heard from the options exchange. And it is our 0 days to expiration options. As you know, options, when they started in 1970 to 73, it completely revolutionized the investing and trading world. And since then, we've moved more and more towards the more liquidity, more activity, and more convenience for the investors and now really the traders. So when the weekly options came around, that was revolutionizing the whole thing. With the weekly options, now rather than waiting for a month for your options to expire, and you had to remember we have the time decay and the premium you're paying, you could actually do some of the short-term swing trading and trading. So finally, a few years ago, we ended up having something with the S&P, especially with SPX and S&P, which we end up coming with 3 days a week rather than once a week. And now we have, and some limited, but the major indices, we have something called 0 days to expiration. And what that is that an option contract which expires within the day. And the reason I wanted to share this with you is because, as you know, we have a lot of day trading strategies, and a lot of them are really towards futures market. But not everyone has access to the futures market, or they don't feel comfortable because there's just so much leverage. You really have to do very much of risk management because of the margins. And because of that, sometimes they shy away with a lot of strategies that we've offered because of solely for that. Now, in my opinion, this 0 days to expiration options kind of resolves and solve that concern. Again, because these options basically open up at 9:30 a.m. New York time, and they expire actually 4:15 p.m. depending on the index. They basically they expired at the same day. So you really don't have to worry about a week from now, a month from now, and the strategies that you want to imply based on that immediate signals that you're receiving, based on technical analysis, based on, we've talked about gap trades and other thing, without really paying too much premium. So you will see there's a lot of advantages, but also, again, very much is about managing your positions. It's about risk management. And again, also reading the market because of the immediate volatility. So one of the things you will notice, this is as of February 25th, you see the growth of the 0 day options. You see how it has really taken over all the other ones. So we see majority of the options, which are by the volume, it has been the big jump in the 0 days option. Even going further, one of the interesting thing is that the retail investors, and this is again the first quarter of 2025, you see retail investors actually uh, have more activity than the institutional investors. As I said, it's more of, I think, replacement if you don't have access to the futures market. So because of that, now you can apply your day trading strategies based on what you have learned, you've been applying. So at a limited risk in a way. So I think my whole subject summary will be right in this slide. And I will go over them and then we will have some examples for you. So When you're trading this, again, you're familiar with options, you know how it works, so I won't go into, again, the foundation of options. It is more about how we can take advantage of the 0 day. Again, it expires end of the day. So one important thing is, listen, this time decay happens very quickly. So remember, we start from the beginning of the day, and it's almost like you have a 30 day. Remember when we talk about that? And then it's just, if you have a 45 days, the last 30 days, and then last week, it just constantly you lose that exponential loss of time because of time decay, the premium. So here, towards the end of the day, you are really now uh, losing the time decay. So you might be right about the direction, but that doesn't mean that you could make all the money that you could because of the time decay. Also, during the day, you watch the markets, you see how they behave. That volatility plays a huge role. So again, you're becoming a futures trader. On top of that, basically now you have the volatility, which is a big factor in the pricing of the options. One other thing is the liquidity. The good news is, because, as you can see, because of all the volume that we have, a lot of these available zero date, they are liquid. So the volume is good, but you have to still consider the bid-ask spread. So make sure you're aware of the slippage, but also the bid-ask spread. The good news about these options are, especially if you don't have a large account but you're proactive, you want to be active during the day, is the low premium. And why is that? Because we just talked about the the expiration is today. So obviously there is no time value for a week from now, a month from now. So that's what, when you compare, you can do the same thing which you for option expiring a month from now, you can actually buy the same thing for 10-15% of that premium. So it allows you to do multiple contracts, as long as, again, you know how to manage your positions, your profits, and your losses. Also, because of that, you have a high leverage. It's just amazing how little movement can make a lot of money for you. One other thing is, especially now, like we're looking at the geopolitics of the world, and let's say you have a portfolio. Now, obviously, you have to pay a high premium, and you know something is coming up in 2 days or a day. You can actually do these short-term hedging. So rather than buying, again, like one of your hedging, let's say you want to buy put option on your account, you were going to go for 3 months, which could be pretty expensive. Maybe your concern was only for 1 day or 5 days or 7 days, and maybe you can just roll it. So basically, it could be a short-term hedging for you. Also, what we've learned, we have diverse strategies. Whether you use vertical spreads, whether you use uh, butterflies, or you're using condors or iron condors or straddles or strangles. You can use all of those as a day trading without really committing a large premium and without waiting. So by end of the day, although it's emotional roller coaster, and that's one of the reasons I like the trading, especially futures trading. I don't like to have open positions because you don't know what will happen overnight. Basically, this allows me to use, let's say, option strategies and be out of it by 1 or 1:15 p.m. West Coast time, and we're done. Something else you have to consider, because uh, this option is expiring, you could have, I mean, let's say you just went directional, you could have total loss. So just remember, the premium could be going down if it doesn't hit your objective. That means the premium that you paid for option plus the direction. So be prepared for that. Uh, on the other hand, obviously, because of that leverage and because of the movement and because of the low cost, you could have tremendous amount of rewards, very high returns. And again, you don't need many of those. So And as I said, I will show you one example on S&P. You see how that works. Just it is right just for today. Um, Position management is very important, and many of you know how I operate. I am all in, but I scale out. I have my targets. I like to meet them and get out. So basically, it reduces my risk during the day, especially again because of volatility. So you want to be able to scale out. Make sure you are, again, you watching your stop losses or maximum losses. It's entirely up to you. As you know, for my options, generally I put a 50%. Maybe you can put 25% stop loss. Again, this is really because of the low cost, you can be a little more aggressive because of the volatility, things can really move. Last but not least, this is very important, especially if you don't have a large account and you want to do this, is our pattern day trading, the PTT. So as you know, if you have more than three day trading in every 5 trading days, you would be considered, according to FINRA, you would be a pattern day trader, and your account could be frozen could be up to 90 days, unless you have over $25,000 in your account. Because remember, when you're using these leverages, you are really doing margins. And in margins, well, you have to be protected and the broker has to be protected. So they have these rules. There are ways around it, but I just want to make sure you understand. So if you're doing this, we have to know a way out. So again, so if you had within 5 days, you have three of these day trading, you could have 10 trade, I mean 10 same thing and get out of it, that would be considered one, but you cannot be in and out 3 times in 5 days. So one quick suggestion I will make for you, we can do the pattern day trading, avoid the pattern day trading by using futures and well, like now we have micro S&P, so you could do MES or E-mini S&P. By doing that, or NASDAQ, by doing that, futures do not go under umbrella of the pattern day trading. And also, because they don't, the options on the futures. And why do we suggest options on the futures, although the spread could be a little high, is because it's the limited risk. When you have pure futures, as you know, if your risk management is not very good, you can lose a lot. But because these are the options, at least you know, based on your strategy, that your risk is defined. So that's one way going around it. Another way, there's something called box trade that's which is using vertical call spreads, vertical put spreads. It gets a little complicated, but you could use that. Or another way will be buying the next days, although we're talking about the 0 day trading, but there's a strategy that maybe you can sell premium at the end of the day, let's say 12:59, or if it's S&P 114, and then buy it back the next day. But that would be 1 day trading, and you need to have a premium. This is S&P. Remember, you don't on ETFs you get assigned, could be assigned, but in SPX is pure cash, so you could lose that whatever you sold the difference, whatever the premium is, you will lose that. So I hope that's helpful. But in a nutshell, this is what the 0 day trading do for you. So one thing again, we want to make sure this premium decay is very important. So we want to make sure we know how that works. We like to buy. In this case, you have different strategies. Obviously, if you buy out of the money, they are very inexpensive because remember, you have only 1 day to expiration or few hours. If you bought, so the chances you might not hit it, but if you did, it could be a huge home run. So you can do it different ways. I usually do at the money. If it's in the money, obviously it gives you more delta and more chances of hitting your goal. But you have the variety of strategies that you could use. So let's go over different things in this situation. I wanted to just purely show you. Um, this is the SPX. So SPX, which is the S&P Index Cash, which is it's pretty expensive to, as you could see, buy, but you could you could do that. You can do the same thing with SPY, the Spider ETF, which is like 1/10 almost. Or as I mentioned, you could do micro S&P. So this is as of today. So it was around 12:20 something this afternoon, West Coast time. And you see how we have the Friday expiration, you have Monday, Tuesday, Wednesday, Thursday, and then next Friday. So when at that moment when you take a picture, so the market was almost 59, let's say 60s, 59.59. So it's at 59.60. Premium is about $4.40. Now, if we go to next week, and we look at the same premium, I'm talking about the call, it's $54. So do you see that the amount of the time, how much it plays a role? Also, the other thing is look at the volume. That's pretty liquid. So that allows you, again, we want to pay the spread is a little, it's not too bad. It's 10 cents. So you have that. So this is on S&P. And again, as I mentioned, you can see you have daily. And then what I did, I took a picture of that and I just want to show you how things work. That was, as I mentioned, it was about 12:20 something. It's like 30 plus minutes before close. The market was that option for 59.60 on SPX was at 440 at the close at 1:15, about 45 minutes later, less, that 59.60 was at $9. You see that spread, but I think it was like about eight something you could have sold it, which is not bad, is it? That's again, um, and still quite a bit of volume. So how about we look at let's say you see that's pretty expensive SPX. Let's do SPY. And with SPY, what I want to do. I'm just showing like next week, but similar things I didn't let's see, it didn't have that for this week. But this, again, the reason I want to show you SPY is, again, you see it's June 20th, which is Friday, and then you have Monday, Tuesday, Wednesday, Thursday, Friday. So you have accessibility to that. How about NASDAQ? And let's say you don't want to do E-minis or you don't want to do micro, so you want to use the ETF. Again, you see that we have NASDAQ Monday, Tuesday, Wednesday, Thursday, Friday. And when we compare, for instance, NASDAQ was at 526. Let's go out of money and then let's look at 528 was at 6 cents. And if you go 528, exactly a week later, it was at 487. So you see the value of um, theta or the time. So you see how time, this is on again about 12:29, right? So these are all at 12:29. You see that the theta, how it just keeps going, how fast it goes, and you lose like 29.8 cents, and that's how fast you will lose. And also Russell, I just, again, mainly I want to share these with you to show you that, look, there is a 0 day um, or every day of the week is available on Russell. Um, the other way, as I mentioned, you could use micro. This is the September features uh, and this is options on them. So you see the volume is not that much. So that's the again, something we had to take into consideration. So uh, there's a huge bid and ask. So that's the dangerous part. So Thinkorswim is not the best. Tasty Work is much better when it comes to options um, on the futures, but I'm just saying it is available. So you can see that the premium is much better when it goes a week from now. Now, if you use we look at gold, for instance, you see now gold has three options, or the 3 out of 5 days. So every other day, Monday, Wednesday, and Friday. And that's what S&P used to be. So you can be proactive with gold if you wanted to. So, as you know, one of my favorite strategies is the gap trade. And again, unless you wanted to use futures, it was sometimes difficult. So you would do options and it would be the next day or 2 days or a week from now. But with this 0 day trading, you could actually use the half a gap fill or you could use the full gap fill, and it allows you that flexibility, especially if you have your account is over 25,000. Obviously it gives you a lot more flexibility to do this. Let me share this. This is just S&P Spider um, uh, chart, 1 minute chart just for today, right? So we had the gap up, and then we went. This is on SPY, so it's S&P SPX is better, but or ES futures are used. But here is similar idea. We close that gap, and what you see is we went from five, let's say 99, we went all the way to about 593. So it was a $6 drop. And then we had this big move, nothing happened, but we've had some of these moves. So let's try that's $6 on S&P. So let's translate that to options. So this is um, an options 594 option. Let's say you wanted to buy that. You could also obviously use a put option. That would have been great. What you see here, basically, the the option was about, let's say when it opened was $4. It did go more than five, and obviously it was at 69 cents. So still was a little bit in the money. So it almost hit zero. You see huge movements on the downside, but you see the volatility how it could move. So let's come back and just look at from 12. This is just, let's say you're looking at this chart is not going anywhere. And let's go back to this. Yeah, you see there's just not much is happening, and you're watching. As you know, I'm not a big fan of after 1240 trading, but let's say you say, well, this is options. I can take a low risk. And you decide to come in and you say, well, you know what? I am right around 1250 for. Look at this. It's 20 cents. Hey, let's just buy a couple of these call options. It's going to expire in less than 20 minutes. Look what happened. That 20 cents within 10, 15 minutes went all the way to almost $2 or $1.90. And even before even the close, you see it went over $1.10 or so. So that's the power of the leverage of these options. And it's done. So you don't have to worry about waiting for the next day. Your job is done. So basically, that's what you could do. So it's 20 cents. That's $20. You could buy five. That's $100. And it's still liquid because it's SPY, and you could scale out. You could, I mean, this is 5 times, it was like 8 times your money being made. So, and especially again, this is in the money I'm doing. I mean, at the money. Imagine if you did out of the money. Of course, the spread, the liquidity should be also consideration. One tidbit, believe it or not, the most popular strategy used by the ODT option traders is actually selling butterfly and iron condor, and this is according to Option Alpha. So this is if you want to really get heavy, it would be really the high probability. This is good. Also, combining some of the strategies we've learned, like we are every day we look at the expected move. We see about 68% chance that the prices will be within that. We can take a look at the ATR and Keltner channels. We can use in and out strategy based on this expected move. So let's take a look at, for instance, silver this week. You see how we went and hit the upper edge and then we got rejected. So that could have been either in and out, or we could have done some vertical spread. Um, if you saw that in S&P, in NASDAQ, in Russell, you could apply it the same day. Now, the good news is with the silver, you have the 3-day options like gold. So as you can see with silver, let's say that was 2 days ago, you could have done Friday's expiration and play that. So we have Monday, Wednesday, Friday expirations. Um, so in conclusion, I hope this is helpful. I don't want to bombard with a lot of information. I just want to tell you this is another tool you can put into your itinerary and use with all the strategies that you've learned, but you don't have the patience, or maybe your account is not that big. You want to do it, as I mentioned, maybe once a week, twice a week. You know your favorite days are like Tuesday to Thursday. Well, let's do that once a day and see what happens. One of the best places to go, I just use this as a resource, is the Chicago Board of Options Exchange. So you can have access to a lot of information. So with that in mind, I hope that was helpful, and I will open up for Q&A. Thank you so much.